I'm Charlotte McLeod with the Investing News Network, and here today with me is Steve St. Angelo, independent researcher at SRSrocco Report. Thanks so much for being here today with me, Steve.
Yeah, Charlotte, I appreciate it. There's a lot happening in the markets. We're seeing some interesting moves in the precious metals this year, and so we've got plenty to talk about.
Before we jump into our questions, I wondered, since it's our first time talking, if you could give me just a brief explanation of who you are and what you do at the SRSrocco Report.
Sure. I started to invest in precious metals, especially silver, back in 2002. I remember buying my first 200-ounce bars for $4.52 an ounce. And I got interested in the precious metals, just like most precious metal investors. The problems with the money printing and the debasement of the currency and all the debt now that's coming on, all these are the typical aspects why you would invest in precious metals as a hedge against inflation or, the debasement of the currency. But as I started to dig deeper, and that's kind of my nature, I always dig deeper. I found out as time went on, I started doing some writing in 2007 and 8, and I found out that the price of silver and gold were kind of based upon what it cost to produce them, because there's no business that's going to produce something at a loss for an extended period of time. And then if you're making good profits, there's always going to be another company that's going to come in and do it a little bit cheaper. And so there's going to be competition. So there is a floor in the metal prices due to the cost of production. So I started looking at the falling ore grades, and I started looking at what it costs to produce silver. And the main ingredient for all that is energy. Without energy, we don't have an economy, and you can't produce any gold or silver. And so when I understood that, and you would think that's common sense, but I just didn't realize that. So that's what I do at the SRSrocco Report. I bring in the foundation of the entire economy and financial system, which is based on energy, and then how that impacts everything. So that's what we do at the SRSrocco Report. And that's also the number one reason why I continue to be a very firm believer in investing and owning precious metals, especially silver.
And you were mentioning to me when we were speaking by email that you're a big believer in investing in precious metals, and that stems from your energy analysis. I wondered if you could get into that a little bit more, because you're definitely right. When we talk about investing in precious metals, I don't think we hear too much about energy most of the time.
Yeah, and that's perfectly true, because when we had the virus, the contagion hit in March and April, everybody started working from home. And then I hadn't watched CNBC for a while. So I put it on, and there were 5 analysts sitting on the screen, and they were talking to the CNBC, and they were all giving their analysis of the market. And this one gentleman, he said, I don't care about energy. It's underperforming the market. The price of oil is falling. I mean, oil fell to a negative price in April. And he says, why invest in energy? He goes, it's only 2% of the S&P 500. Well, without that 2% of the S&P 500, you don't have an S&P 500. And so I think that's the issue. When you get up in the morning and you make breakfast and you take a shower, and then you want to go to work, and then you get to work and you want to get home, and then if you don't use energy, you've got to use energy all day long. And I tell people, I challenge in this, don't use energy for one day and tell me how far you got. So what's happened in this complex world we live in, with a lot of technology and a lot of levels of the supply chain, we just forget about the energy. We take it for granted. And that's fine when the energy supply and the energy I call return on investment, it is positive and is in a good position. But when there's problems with it, then the entire system is in trouble. And we are now in trouble. And that's the reason why we're seeing a lot of debt being added to the system. There's a lot of problems with systemic leverage. And actually, that's a systemic problem or an issue due to this falling energy return on investment. So that's what we try to focus on. And I believe most people don't understand it, because a lot of the stocks, bonds, and real estate where most people have their investments, that's based upon oil production growth. And if you don't have oil production growth, those assets start to unravel. And so the difference is gold and silver are different valuations. They're real money. And so in looking at gold and silver in a totally different way, it's much more important now as we start to get into trouble with oil, and that's what I focus on. That's the number one energy source that drives everything is oil. That's becoming problematic. And we discussed that in detail at the SRSrocco Report. And when that becomes problematic, you're going to start seeing a decline in the values of stocks, bonds, and real estate. And to protect your wealth, more and more investors, as we're starting to see now, are going to move into the precious metals.
And I wondered if you could go into some of those problems that we see a little bit more. I know you've spoken quite frequently to your followers about analysts and how they don't necessarily talk to each other. For example, a precious metals analyst, like you mentioned, is not thinking about energy. So what types of problems is that creating, if you could go into that a little bit more?
Sure. I have a chart. I made a graphic, and precious metal analysts understand the problems that are happening, but they don't seem to focus or care about energy. And then the energy analysts I look at that understand the problems we're facing, they don't care about precious metals. And they should, because if there's going to be problems with energy, which they say there's going to be problems with energy, then why would you want to be in a 401k? Because the underlying factor, and this has been proven, the only way you could get global GDP growth is if you have global oil production growth. Whenever global oil production growth starts to trend down, it pulls down the GDP. So if we're going to have a continued downward trend in oil production, which we're going to, then that means GDP will continue to decline. And unfortunately, the energy analysts don't get the precious metals. And then the worst of the three are the financial and economists. They don't really care about energy or the precious metals. So we're seeing that the left hand doesn't know what the right hand is doing, and we try to connect the dots. And so I think that's the issue. And it's almost done because it's like, I'll give you an example. Peter Schiff believes if we back the money supply with gold, if there's a new gold standard, then we're going to see economic growth in the United States like we've never seen before. I disagree, because even if we go on a gold standard and back money with gold, it doesn't change the energy situation. And so I don't see a recovery coming in the future, even on a gold standard. But that doesn't mean you shouldn't own gold or silver. You should even more. So that's the difference between how I look at the precious metals or someone like Peter Schiff that doesn't seem to understand what's happening with energy.
And you have also been talking a little bit about falling ore grades and your research on that. I think in general, people know that ore grades are lower than they used to be. But what do the numbers actually look like for gold and silver mines right now?
Good question. So we tend to look in a Twitter world nowadays, right? And that's 2-3 sentences. And so everything is so fast. But if you start looking back, you start looking at a few pages, and maybe you start reading a few documents, and then a lot of documents. And going back into time, you find out that the average silver ore grade in the late 1800s was between 25 and 50 ounces per ton. Now, when I looked at the top 7 silver miners in 2005, they were producing silver at 13 ounces per ton. That's the average. Now, these same 7 silver top producers, they produced silver last year at 6 ounces per ton. So that's more than a 50% decline. So what that means, Charlotte, they have to move twice as much ore, more than twice as much ore, to produce the same amount of silver. And now when energy prices are going up, and then you've got to move twice as much more ore, that just impacts the silver price. And so and in the same way, the gold ore grades were like 20 to 25 grams per ton in the late 1800s. And now the mining industry is basically down to mining gold dust. and that's between 1 to 2 grams per ton. So that's why it's so much more expensive to produce gold, because it takes about 100 times more energy to produce an ounce of gold than an ounce of silver. And that's what it comes down to. It's all down to the energy.
I was definitely going to ask you what this all means for mining costs, which you've outlined pretty well. So we've seen mining costs increase. What about technological advances in mining? Have they been able to help miners reduce their costs in any ways?
In some ways, yes. But what you see, this is the thing about technology. Technology isn't a Star Trek replicator where you push a button and then out comes the food or whatever. It would be nice if that happened, but unfortunately, the more you use technology, the more it costs. See, technology isn't free. And then, so even though we think a computer is very efficient, because now what a computer can do compared to what a computer that was in a room back in the 60s in IBM, the problem is all the technology in the supply chain to make that small laptop computer is much greater than what it was in the 1960s. And so even though we are using technology to advance things or to maybe access more silver or gold than we could before, that technology comes at a cost. And so, for example, I looked at Pan American Silver. Back in 2000, early 2000s, Pan American Silver was their total cost was between $4 and $5 an ounce. Well, I looked at their first quarter this year, 2020, it's over $16. That's not their all-in sustainable cost. That's not their cash cost. That is what my estimation of total cost, including everything. And so I look at it a little differently, but the all-in sustaining cost tends to use the byproduct credits. They use those to make the actual cost to produce silver lower. And to me, that isn't correct, because those aren't credits. Without those, they would be losing more money or making a lot less money without that byproduct credits. So we could see in just 15 years, it's tripled or quadrupled Pan American Silver cost of production. And that's the reason why the base price of silver has gone up from $5 an ounce in 2004, 5 to 16 plus an ounce today. And it's the same thing with Barrick and Newmont. Barrick and Newmont, it cost them about $370 to produce gold in 2004. Now it's over $1,350. So you can't mine something unless you have the money to do it. And so some of these analysts like Harry Dent Jr., who was suggesting a year or so ago or 6 months ago that silver or gold would go down to a 700 again, he's a typical analyst who doesn't even look at energy and why there's a base price in the metals due to their cost of production.
Okay, I think that's starting to help me understand. So what is that base price then for gold and silver, and how do we use this information to understand what could be coming in the long term for precious metals prices?
There's two ways to value gold and silver, and this is important, I believe, for your listeners, followers to understand. There is the cost of production and supply and demand, but that's how you value a commodity. But commodities get used up, like corn and even copper, they get used up. They do get recycled, but a lot of commodities get used up, especially energy. Now, gold and silver have been valued due to their cost of production and supply and demand forces. But they're also better than commodities. They're money, because a lot of the gold that's been mined in the last 400 or 500 years is still with us. So it performs as money. And that's what we're seeing now. When we see the gold price, especially in 2010, 11, as well as the silver price, when they get pulled way above their cost of production, that means investors are getting worried and they're demanding more, and they're pulling it above their cost of production, which is more as a monetary asset. And again, this is only a very small percentage of the overall market. Investors, it's only a few percentage that are doing this. So the thing is, we're transitioning away from, I believe, and I'm seeing this right now, I believe the metal prices are going to continue to disconnect from their cost of production due to the problems we're going to have with energy. Because all the other things we're using as a value, either currency or stocks, a lot of people in stocks, a lot of people are in bonds, and a lot of people own real estate. When those values start to decline, because as the energy production falls, there's just less economic activity, which is going to bring down the value of these assets. So if you want to protect your wealth, you're going to see more investors transition out of those assets and into the metals. And we saw that, the beginning of that, during this pandemic, when you couldn't even get silver. And I think we're just in the first inning or two of this transition. So I anticipate much higher values for gold and silver because they are what I call stores of energy equivalent value, whereas stocks, bonds, and real estate are energy IOUs. And all I'm saying is you have to continue to burn more energy in the future to give those stocks, bonds, and real estate value. Gold and silver, that coin that you're holding in your pocket, the energy was burned in the past. That's the big difference that investors don't get. A dollar, a fiat dollar, $100 bill, is an IOU. Of course, it's got the word note written on it. Anything that is a note is not an asset. It's something you owe. And that dollar bill gets its value from burning oil. There's the petrodollar. So you want to move out of these assets that are going to get increasingly in trouble and into the precious metals. So in conclusion, Charlotte, we could see, I don't like to give a price, but we could see very, very high values for gold and silver as investors start waking up to the problems we're going to be facing. And this huge increases in debt is just making the situation worse. And I believe we're going to probably see double and triple the prices of these metals. And I will say silver is likely going to outperform gold significantly because right now there's about the same amount of above ground silver investment stocks in the world as there's gold. About 1-to-1. Even if we double it to 2-to-1, when people try to access real silver, there's just not that much of it. Most of it now is either in landfills or it's being used in industry or it's in your switch in your home, in your light switch. That's where the silver is. It's mostly gone.
You've given us a lot to think about. One question I do have, when you talk about energy, I know you've mentioned oil as the most important source of energy. How do you factor renewable energy sources into the picture? I know that's not something that's used in mining a lot, but I do think some companies are looking at that. So how does that fit into it?
First of all, the wind turbines, the wind power and solar power and geothermal power doesn't have a high enough energy return on investment. It's not a solution. Actually, they make the situation worse. There's a lot of problems I can talk about. The more you add solar and wind to a grid in a region or a state or an area, what happens is when the sun stops shining or the wind stops blowing, you need to bring on this natural gas generating power to offset it, and it's very expensive. And so that's the problem with using wind and solar. And that's one problem. The other problem is, again, getting back to the Star Trek replicator, you cannot produce a wind turbine or solar panel by a switch of a button. It takes the massive burning of oil, natural gas, and coal to produce those wind turbines and to produce those solar panels. And then here's the problem. While the wind is renewable and the sun is renewable, the wind's going to continue to blow, the sun's going to continue to shine. According to the estimates I've seen, the amount of waste from solar panels that can't be recycled, it's not economic to recycle them, and wind turbine blades, it's going to go up exponentially over the next 10 years. So what they're doing, they're taking down the old wind turbine blades, they put new ones up, they have to remanufacture the whole turbine. And then you know what they do with these wind turbine blades? They cut them up and they put them in landfills. So I don't see where that's renewable. If those wind turbines would last, let's say 200 years or 100 years, I would say, okay, that they are somewhat renewable. But after 15 years, those wind turbine blades are taken down because the leading edge of the wind turbine blade gets eroded from all the salt if it's offshore, or all the particles from rain. The leading edge gets worn off, and then they have to be replaced. And the most economical way to do that is to take them down, cut them up in pieces, because some of these are huge, and then they put them in landfills. So if that was a viable solution, renewable, I would say yes. But again, it takes oil, natural gas, and coal to make all those things. And if you have to remember, it also takes oil to make gas. It takes a lot of trucks fracking wells or doing shale gas wells or even natural gas wells to produce the natural gas. So you need the oil to produce the natural gas, and then you need the diesel in the locomotives or the equipment that extracts and transports the coal. And so actually the oil is the #1 energy source that allows these other energy sources to work or not to work. So I hope that answered your question.
Yeah, you did. And really, it seems like a much broader discussion topic than we maybe have time for right now. But thank you for going into those details. I think that helped give a quick look at what's going on there. As we wrap up, I did want to ask, what do you want investors to take away from all the information that you've provided? And, you know, for those who agree that precious metals are the way to go as an investment, what's the best way to do that? I'm really curious to hear what you would think about the stocks, physical, how you would go in terms of that.
Sure, that's another good question. And before I get into those different aspects of the metals, I would say that energy, you know, when I bring up energy to people who don't really connect the dots, you could see their eyes glaze over and they get bored. And that's unfortunate. Because I could tell you, if the energy gets shut off at your house for a week, people are good. They're not going to be bored. You know, well, they may be bored, but it's amazing when the energy gets shut off at your house. It's like, okay, when's it going to be turned back on?
Yeah.
So we take that for granted. And so it's very important for precious metal investors to really understand what's going on with energy. And we discussed it at the SRSrocco Report. Now, that's the reason why I believe owning in the precious metals, because #1, when people who understand energy like I do, they're not going to sell their metal, because, you know, the idea that the central banks can continue to add more debt, let's say they continue to manipulate the metals, well, then they could do that forever. Well, but the problem is, if the energy becomes a big problem, and it is, if you want to print money and your energy production falls, you look like Venezuela, which is hyperinflation. And that's a very good possibility of where we're heading in the future. So the central banks cannot continue to manipulate the metals. Why? Because the energy situation is going to pull that rug from underneath them. So if you're going to get into the metals, this is how I look at it. Again, this is for educational purposes only. I'm not a professional financial analyst or a planner, but this is how I look at it. You should mostly be in physical metals. That is the #1 protection, is in the metals. If you're good at trading, then I suggest you do that in the ETFs, in the gold and silver ETFs. That's a good market for trading. And what's interesting, though, Charlotte, in this last 6 months, most of the increase in the metal price has come from the paper trading. The metals, or supposed metals, that are flowing into the gold and silver ETFs. Because according to the data I'm looking at, there was about 200 million ounces plus that moved into the silver ETFs. And I'd imagine over the same time period, maybe there was 30 to 40 million ounces of physical silver purchased, whether that's silver eagles, maples, bars, coins, all the other official silver coins. So we could see a lot more leverage went into the paper. I see that moving to the physical in the future. And then there are the mining stocks. And to me, this is where, if you want to speculate, depending on the person's income, or let's say investment funds. If you don't have a lot of investment funds, you should not be investing many in the miners, even though they could do well. It's too risky. You should have most of your metals, most of your funds in the precious metals as is physical. The stocks, I believe, are going to do much better than people realize, especially silver. And why? Because it takes 100 times less energy to produce an ounce of silver than gold. When energy becomes problematic, Charlotte, and it will, the gold mining industry is going to get into trouble because it's not going to have access to the energy it did before. And it takes a lot of energy to produce an ounce of gold. So to me, the shining star is going to be the silver mining stocks. And there aren't that many good producers. While there are a lot of juniors, a few of them that will become mines, they're not really high quality mines. They're not bad. But to me, if you're going to get into the stocks, the safest thing is to own the producers first and foremost. And if a person wants to speculate and they have more funds to speculate, then you can get into the juniors, because the juniors will provide more upside. But there's also more risk, because we have to understand, when we have problems with energy, a lot of these junior mining companies are not going to become mines. But that doesn't mean that their price, because they got the name silver in their stock price, won't go up with the tide. So I hope that kind of explains how I look at the precious metals and the different ways to invest in them.
It does. That was very helpful. And I have just one more question before I'll let you go. And that is, this energy crunch, these difficulties that you see coming, do you have a timeline of that? I know, I'm sure it's hard to pinpoint, but what kind of time frame are you looking at?
There's different analysis, but I will be doing an interview with Dr. Louis Arnaud, and he looks at the thermodynamics of oil depletion. And he sees we're going to be in very big trouble by 2030. And so if you look at what's happening with the debt, the increase in debt is trying to offset this falling energy return on investment. And just let me give you a quick example. The Roman Empire, they gave a lot of reasons why the ancient Roman Empire collapsed, but the main reason was the falling energy return on investment of the empire. And when it fell to a certain level, they couldn't sustain it. And along that way, they debased the currency, the silver denarius. Well, the US is in the same predicament as well as the rest of the world. And so the timeline I give is, because the Fed increased, lowered the interest rate to 0 back in 2007, it brought on the US shale oil bubble, the boom and bust. We brought on a lot of shale oil production, but that's like a boom and bust. And I believe we're in the bust phase. And I discussed that at the SRSrocco Report. But here's the clincher. The shale industry accounted for more than 75% of global oil production growth over the past 10 years. And what did I say in the beginning? Without global oil production growth, there's no GDP growth. So we can thank the Federal Reserve for lowering interest rates to 0 to allow this really uneconomic shale oil production to be produced, where there's over 300 billion in debt now. And now we're going to start to see the collapse of US shale oil production. So to give you my brief answer after I explain that, I think within 5 years, we're going to start seeing a great deal more problems with energy. And by 2030, the world will look like a much different place. And so, and I believe US oil production, we're not going to remain energy independent. The US was energy independent for about 6 months. It could be for a few more months, but that's going to quickly die away as US shale oil production falls by 50 to 75% over the next 9 years. So to me, Big troubles start within 5, and the world will look like a much different place by 2030.
Well, that sounds like a good place for us to end it. Thank you so much for being here and sharing all of that information. I feel like I learned a lot, and I think that'll be really helpful for our listeners.
Well, thank you. And if your listeners would like to find out more information, we do provide some public articles, but there's also some subscription content, and we do put out a lot of original analysis that you won't find anywhere else on the internet. And I do appreciate your time to talk with you today.
Thank you so much. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Steve St. Angelo with the SRSrocco Report.